Break-even analysis. The key to unlocking profitability. Imagine you're the owner of a small boutique store specializing in trendy clothing for young adults. You've been operating for 6 months, but your sales are still not covering all your expenses. You need to know when your business will break even and start generating profits. In this video, we'll explore break-even analysis (BDA), a powerful tool that helps you determine when your business will reach profitability. As the owner of a retail store, you are no stranger to managing costs and pricing strategies. However, understanding BDA can help you make informed decisions about investments, resource allocation, and even marketing campaigns. Let's dive into the world of break-even analysis. First, let's define what break-even means. In simple terms, it's the point at which your revenue equals your total fixed and variable costs. Think of it as a threshold. When you surpass this point, your business starts generating profits. To illustrate this concept, let's consider an example. Suppose your boutique store has average monthly sales of $50,000. Your fixed costs include rent $15,000, salaries $10,000, and marketing expenses $5,000. Variable costs are mainly related to inventory, which amounts to 20% of the selling price. If you're selling a t-shirt for $25, your variable cost is $50.20 x $25. Next, let's calculate the break-even point using the following formula. BEP equals fixed cost / selling price variable cost. Plug in the numbers. BEP equals $30 fixed cost / $25 $5 equals $30 $20 equals 1,500 units. This means you need to sell at least 1,500 t-shirts per month to break even. However, this is a static calculation and doesn't account for any changes in pricing or sales volume. To make BEA more dynamic, we can introduce the concept of contribution margin (CM). CM represents the amount by which revenue exceeds variable costs. For our example, CM would be $20, $25, $5, making it easier to calculate the break-even point. Finally, let's discuss how BDA is used in real-world scenarios. Retailers often use this analysis to decide on promotional pricing or discounts. By knowing their break-even point, they can determine whether a discount will impact profitability. For instance, if you're planning to offer 20% off all t-shirts for the next month, you'll need to reassess your BEP and CM to ensure that this promotion won't erode profits. Quick recap. Break-even analysis is a tool used to determine when business revenue equals total costs. The formula for calculating the break-even point involves fixed costs, selling price, and variable cost. Contribution margin can make BDA more dynamic by accounting for changes in pricing or sales volume. Now that you understand break-even analysis, apply this concept to your own business. Ask yourself, what is my current break-even point? How will I adjust my pricing or marketing strategy to reach profitability? In the next video, we'll explore another essential tool for entrepreneurs: cash flow management. Stay tuned. Let's dive deeper into break-even analysis and explore its practical applications. When using BDA, it's essential to understand that your break-even point is not a fixed number, but rather a dynamic variable that can change with fluctuations in sales volume or pricing. For instance, if you're selling more t-shirts than expected due to a successful marketing campaign, your BDP might decrease accordingly. To account for these changes, let's revisit the formula. BDP equals fixed cost / selling price variable cost. Notice how the contribution margin $20 plays a crucial role in determining the break-even point. If you increase the selling price or reduce variable costs, CM will rise and your BDP will decrease. Conversely, if you lower the selling price or increase variable costs, CM will decrease, resulting in a higher BDP. This is why retailers often use BDA to assess the impact of promotional pricing on their profitability. For example, imagine you're planning to offer 20% off all t-shirts for the next month. If your current break-even point is 1,500 units, with CM at $20, this promotion might seem like a good idea. However, if you calculate the new BDP after applying the discount, you might be surprised. Assuming the same fixed cost $30,000 and variable cost per unit $5, but with the discounted selling price of $20 25% off original price, your CM would decrease to $15. 25% equals $15. Using the updated BDP formula, BDP equals $30,000 $20 $5 equals $30,000 $15 equals 2,000 units. Suddenly, you need to sell at least 2,000 t-shirts per month to break even. This example illustrates how a seemingly minor change in pricing can significantly impact your business's financial performance. By regularly reassessing your BDP and CM, you'll be better equipped to make informed decisions about marketing strategies, pricing, and resource allocation. Now that we've explored the importance of break-even analysis in dynamic scenarios, let's examine its role in other areas of business decision-making. Using BEA for strategic planning. BDA can also inform long-term strategic planning. For instance, if you're considering expanding your product line or entering a new market, you'll want to assess the potential impact on your break-even point and overall profitability. To do this, estimate the additional fixed costs associated with the expansion, for example, increased marketing expenses, hiring new staff, and calculate the updated BEP. This will give you a clear understanding of whether the investment is likely to pay off or put pressure on your business's finances. Applying break-even analysis in different industries. While we focused on retailing, BDA has applications across various industries, including 1. Manufacturing. Calculate the break-even point for production runs and adjust accordingly. 2. Food service. Determine the optimal menu pricing to maintain profitability during peak periods or seasonal fluctuations. 3. Software development. Assess the break-even point for different product lines or features to prioritize development. By recognizing the versatility of break-even analysis, you'll be better equipped to apply its principles in a wide range of business contexts. As we conclude our exploration of break-even analysis, remember that this tool is not meant to be static. Regularly reassess your break-even point and contribution margin to ensure they remain aligned with changing market conditions and internal operations. In the next video, we'll delve into another crucial aspect of cash flow management. Stay tuned. When applying BEA in different industries, it's essential to consider unique factors that can impact break-even points. For example, in manufacturing, you may need to account for variations in material costs due to fluctuations in global markets or supply chain disruptions. In the food service industry, pricing strategies must balance the need to maintain profitability with customer expectations and seasonal demand. A restaurant owner might use BDA to determine optimal menu prices during peak periods, such as summer weekends or holidays, when demand is high but labor costs are also increased. In software development, companies often face challenges in predicting break-even points due to the long product development cycle and variable sales volumes. By applying BDA to specific product lines or features, developers can identify which projects have the greatest potential for return on investment and allocate resources accordingly. To ensure effective implementation of break-even analysis across various industries, it's crucial to maintain a dynamic perspective. Regularly review your business model and adapt your break-even point calculations as needed to reflect changes in market conditions, customer behavior, or internal operations. By doing so, you'll be able to make informed decisions about pricing, resource allocation, and strategic planning, ultimately driving long-term profitability and sustainability.